Central banks are crumbling. Right now, in vaults you will never see. Something is happening that no government wants you to notice. They are not selling gold anymore. They are hoarding it, quietly, aggressively, at a pace the world has not witnessed in decades. And while everyone is watching stock markets celebrate, the same institutions that print your money are preparing for something else entirely. Something they are not announcing on the news. Because if this trend continues into 2026, the value of the cash sitting in your bank account may never be the same again, and silver, the metal most people have completely ignored, could become the most important asset of the decade, but only if you understand what is coming next. Welcome, dear friend, to Currency Insight. If you're joining us for the very first time, please settle in comfortably, because what you're about to learn is something every wise person deserves to know before it is too late. And before we continue, may I ask you for a small favor? If you find value in the truth we share here, please take just a moment to press that subscribe button. Think of it as planting a seed today, so that tomorrow, when the storm comes, you're not left searching for shelter in the rain. It costs you nothing, but it means everything to us. Now, tell us in the comments below, from which city, which country are you watching this from today? We read every single one, and it warms our hearts to know how far this message has traveled. Now, let us begin. You said, write 800 words for part 1. The story must be interesting and keep the audience engaged. For decades, the world believed a simple story. Central banks, the most powerful financial institutions on earth, were slowly walking away from gold. Analysts called it an outdated asset. Bankers called it a relic. The smart money, they said, had moved on to bonds, currencies, and digital systems of value. That story felt true for a long time. Then, quietly, the numbers began to tell a different tale. In recent years, something shifted. Central banks did not abandon gold. They started buying it again, and not in small amounts. China led the way, with purchases rising at a pace that surprised even seasoned economists. Other nations followed. The institutions that control the world's money supply, the same ones that print currency and set interest rates, began stacking gold reserves at levels not seen in modern history. This was not a random decision. Central banks do not act on impulse. Every move they make is calculated, deliberate, and often hidden from public view until the data quietly leaks out months later. So when these powerful institutions start buying gold aggressively, it raises an important question. What do they know that ordinary people do not? The answer lies in a concept most people rarely think about: the global money supply. Every year, more currency is created. Governments spend more than they collect. Central banks expand their balance sheets to keep economies moving. This sounds harmless on the surface, but it carries a heavy cost. As more money enters the system, each unit of that currency becomes worth slightly less. It happens slowly, almost invisibly, but it never stops. Gold has always been the natural response to this problem. It cannot be printed. It cannot be created out of thin air by a committee or a computer. Its supply grows slowly, year after year, regardless of how desperate governments become for cash. This is why, throughout history, gold has served as a form of insurance against the slow erosion of paper currency. But gold is only half of this story. Silver, the quieter metal, has been moving in the background, almost unnoticed by the average investor. While gold captures headlines, silver carries a unique advantage that gold does not have. It is not only a store of value, it is also an industrial metal used in electronics, solar panels, medical equipment, and countless modern technologies. This means silver responds to two forces at once: the same monetary pressures that drive gold higher, and the real physical demand from industries that cannot function without it. This dual nature makes silver a fascinating asset to watch. When confidence in paper currency weakens, investors turn to silver as a safe place to protect their savings. At the same time, when factories and technology companies need silver for production, that demand does not disappear, even during uncertain economic times. Few assets carry this kind of double demand, and even fewer are priced as low as silver currently is compared to gold. Meanwhile, on the surface, financial markets appear calm. Stock markets continue to rise. Business news channels speak of optimism, growth, and recovery. To the average person, everything looks stable, but underneath this calm surface, a quieter and more serious shift is taking place. The institutions with access to the deepest financial data, the central banks themselves, are positioning their reserves away from paper assets and into something physical, something that cannot be devalued by a printing press. This creates a strange and important contradiction. Public markets are optimistic, central banks are cautious. One of these two views must eventually be wrong. History has shown again and again that when central banks quietly prepare for trouble while the public remains unaware, the public is usually the one caught off guard. For business owners, entrepreneurs, and serious investors, this is not a moment to ignore. It is a signal. The same institutions trusted to protect national wealth are choosing gold over currency, and slowly, the attention is beginning to shift toward silver as the next logical step. The quiet reversal has already begun. The only question left is whether ordinary people will recognize it in time, or whether they will realize the truth only after the shift has already taken place, when prices have already moved and the opportunity has already passed. Something strange is happening in the world economy, and very few people are talking about it clearly. On one side, stock markets are smiling. Investors feel confident. Business news repeats the same comforting words: growth, recovery, stability. On the other side, a quieter and more serious battle is taking place inside bond markets, the part of the financial system that rarely makes headlines but often tells the truth first. This is the trap. Two opposite stories cannot both be true at the same time. Either the optimism in stock markets is correct and the economy is genuinely healthy, or the warning signs in bond markets are correct and inflation is far from finished. History shows that when these two signals disagree this sharply, it is usually the quiet warning that turns out to be right, not the loud celebration. To understand why, it helps to look at what inflation really is. Inflation is not just rising prices at the supermarket. It is a sign that money itself is losing strength. When governments spend far more than they collect in taxes, they cover the difference by creating new currency. That new currency flows into the economy, and slowly, the value of every existing dollar, euro, or rupee becomes diluted. It is similar to adding more water to a glass of juice. The glass looks fuller, but the taste becomes weaker. For the past few years, many people hoped this problem was temporary. They believed inflation was a short-term shock caused by global supply chain disruptions and unusual events. But a deeper, more uncomfortable possibility is emerging. Inflation may not be a temporary visitor. It may be a permanent guest, one that simply changes its behavior depending on the season, sometimes quiet, sometimes loud, but never truly leaving the house. This distinction matters greatly. The danger is not necessarily that inflation will suddenly explode higher. The greater danger is that it stays present, steady and stubborn, quietly eating away at savings year after year while everyone assumes the problem has already been solved. This is where central banks face their hardest decision. Raise interest rates too aggressively, and they risk breaking an already fragile economy. Keep rates too low, and they allow inflation to continue its slow, silent damage. There is no perfect answer, only a careful balancing act between two uncomfortable outcomes. Some major central banks have already made costly mistakes in this balancing act. In certain cases, interest rates were raised at exactly the wrong moment, just as industrial activity and commodity demand were already slowing down. Instead of solving the problem, these decisions added new pressure onto economies that were already struggling to find stable footing. It served as a clear lesson. Reacting to short-term political or geopolitical noise, instead of focusing on the deeper, structural signals of money supply and employment data, can lead policymakers in the wrong direction entirely. This is precisely why experienced economists urge a different approach. Instead of overreacting to dramatic headlines or temporary geopolitical tensions, central banks should focus on three quieter but far more reliable indicators: the rate at which the money supply is expanding, the underlying core inflation figures with volatile items removed, and the strength or weakness of employment numbers. These three signals, taken together, tell a more honest story than any single news cycle ever could. For everyday people and business owners, this entire situation carries an important lesson. Inflation does not always arrive with loud warning sirens. Often, it arrives quietly, disguised as normal life. Prices creep upward. Wages struggle to keep pace. Savings that once felt secure begin to lose their real purchasing power, even while the number in the bank account stays exactly the same. This is why gold and silver continue to attract serious attention from those who understand this pattern. They are not simply investments chasing short-term profit. They are protective tools designed to preserve value when paper currency slowly weakens behind the scenes. The bond markets are already sending their warning. The only remaining question is whether the rest of the world will listen now, while there is still time to prepare, or whether they will only understand the message once the cost of inflation has already taken its toll on their savings, their businesses, and their future plans. While most people watch headlines about inflation and interest rates, a quieter movement is taking place beneath the surface of the global economy. Money is moving. Not loudly, not with dramatic announcements, but steadily, as experienced investors and institutions quietly shift their capital away from positions that feel risky and toward positions that feel safer for the years ahead. This silent repositioning often says more about the future than any news headline ever could. The first major shift involves currency itself. For a long period, many large investors held heavy positions in the dollar, treating it as the safest place to park their wealth during uncertain times. But as geopolitical tensions began to ease, something interesting happened. Instead of staying in the dollar, many of these investors started reducing their exposure and moving toward gold and silver instead. This was not a small adjustment. It represented a meaningful change in how professional money managers view safety itself. The dollar was once the shelter during the storm. Now, increasingly, that shelter is being seen as gold and silver. At the same time, a very different kind of warning is forming inside the oil markets. For months, enormous amounts of borrowed money have been used to bet on rising oil prices. These are called leveraged long positions, and they can be extremely dangerous when conditions change. When an asset becomes overcrowded with this kind of borrowed optimism, even a small price drop can trigger a painful chain reaction. Investors are forced to sell quickly to cover their losses, which pushes prices down further, which forces even more selling. This cycle is sometimes called a margin call spiral, and experienced market watchers are already seeing early signs that oil could be approaching exactly this kind of dangerous moment. For this reason, many serious investors are choosing to stay away from oil entirely right now, preferring patience over risk. While oil faces this uncertain future, attention is quietly shifting towards smaller and often overlooked corners of the stock market. Small and medium-sized companies, the kind that rarely make front-page news, have begun attracting renewed interest. These companies are often more sensitive to economic conditions, which means they can suffer the most during downturns, but they can also recover the fastest once confidence returns. Patient investors see this as an opportunity to position early, before the broader market fully recognizes the shift. A similar pattern is appearing in certain emerging markets, regions that were heavily affected by recent geopolitical conflicts and tension. These markets were sold off aggressively while fear was high, often dropping far more than their actual economic fundamentals would justify. Now, as some of that geopolitical pressure begins to fade, these undervalued markets are slowly attracting attention from investors looking for stronger returns once stability returns to the picture. Even the bond market, the very place sending warning signals about inflation, contains hidden opportunities. Certain companies with strong cash flow and healthy debt levels have seen their bonds unfairly punished, simply because they were caught in the same wave of fear affecting the broader market. For patient investors willing to look closely, these bonds offer a rare combination: attractive returns alongside genuine financial strength, sitting quietly overlooked while attention remains focused elsewhere. What connects all of these movements, the shift away from the dollar, the caution around oil, the quiet interest in small companies, emerging markets, and selective bonds, is a single underlying theme. This is not a market driven by panic. It is a market driven by careful repositioning, where experienced capital moves quietly before the crowd understands what is happening. This is precisely why gold and silver continue appearing at the center of this story. They are not isolated trends. They are part of a much larger pattern, one where money is steadily preparing itself for a future built on caution, rather than blind confidence. The question that remains is simple. Will ordinary investors notice this repositioning while there is still time to act, or will they only recognize the pattern once the shift has already been completed by those who moved first? Every story eventually arrives at its turning point. The story of gold, silver, and central bank behavior has now reached exactly that moment. Throughout this analysis, one thread has remained constant. The institutions with the deepest access to financial data, the central banks themselves, are not behaving like organizations confident in the strength of paper currency. They are behaving like organizations quietly preparing for a different reality. Three forces are now converging at the same time, and together they paint a clear picture for the months ahead. The first is the steady structural growth of the global money supply, a trend that shows no sign of reversing. Governments continue spending beyond their means, and that gap continues to be filled with newly created currency. The second is the persistent nature of inflation itself, not necessarily exploding higher, but remaining stubbornly present, quietly reducing the real value of savings year after year. The third, and perhaps most telling, is the accumulation of gold by central banks at a pace not seen in decades, a clear signal that those who manage national wealth are protecting themselves against the very system they oversee. When these three forces are placed together, the conclusion becomes difficult to ignore. Hard assets, the kind that cannot be created with a printing press, are positioned to play an increasingly important role in protecting wealth through 2026 and beyond. Gold has long carried this responsibility, and its position appears likely to strengthen further. But silver holds something gold does not. Because it serves two purposes at once, a monetary safe haven and an essential industrial material, silver carries the potential for sharper, more pronounced movement. Its market is smaller than gold's, which means meaningful shifts in demand, whether from investors seeking safety or industries requiring the metal for production, can move its price more dramatically. This dual demand, combined with a market that has remained historically undervalued compared to gold, places silver in a particularly interesting position as 2026 approaches. For business owners, entrepreneurs, and serious long-term investors, this entire analysis carries a practical lesson that extends beyond any single asset. The traditional approach of holding large amounts of cash and government bonds, once considered the safest possible strategy, now carries a hidden cost. With persistent inflation quietly reducing purchasing power, the real value of that safety can erode silently over time, even while the numbers on a statement remain unchanged. A wiser approach, the kind already being practiced by the very institutions discussed throughout this analysis, involves rebalancing, reducing dependence on sovereign bonds, increasing exposure to hard assets like gold and silver, most importantly, accepting a level of calculated risk rather than retreating into false comfort. Conservative thinking, when taken too far in this kind of environment, becomes its own form of danger, allowing inflation to quietly consume wealth while it appears to be protected. The central banks have already made their decision. Quietly, deliberately, without dramatic announcements, they have chosen gold over currency, preparation over complacency. The remaining question is not whether this shift is real. The evidence already confirms that it is. The real question is whether individuals, business owners, and everyday investors will recognize this shift early enough to position themselves accordingly, or whether they will only understand its full significance after the opportunity has already passed, and prices have already moved far beyond where they stand today. The warning has been given. What happens next depends entirely on who chooses to listen.